I'm Navraj Bhardwaj. Uh, I work at AQR Capital Management. AQR stands for Applied Quantitative Research. A little bit about myself. I've been with AQR for almost 8 years now. Um I did my bachelor's in computer science at the University of Illinois Urbana-Champaign. I did my master's in electrical and computing engineering at Carnegie Mellon. I've done a bunch of things since then. I started out in foreign exchange market making, equity trading, and then finally ending up at AQR doing quantitative research and portfolio optimization, signal implementation, and most recently creating a research ecosystem to be able to do quant research and analysis. So let's get started. Um, Disclosures because we have to. And so a little introduction to AQR. What is AQR? We are one of the largest asset managers that exist out there. We have about $226 billion assets under management. That is as of June 30th this year. We are based in Greenwich, Connecticut, US. And we are really excited. One of the things that recently has happened is that we are opening an India office in Bangalore. And it's really exciting time for us because we get to tap into a brilliant uh, pool here in India. And AQR culture is a quant firm, so there's a lot of skills that come together to create to solve challenging problems. And I believe there's a lot of common ground. What we find here in India, there is a culture of entrepreneurship. There is engineering, passion for technology, and the startup culture that we have in our DNA. We are research driven. We are totally systematic. We are a quant fund, so technology plays an important role as well as the finance. Um, and we have investment strategies that range from total return fund strategies to beta driven strategies. Something about AQR culture. I cannot talk about everybody, but I can talk about myself. AQR culture is, as I mentioned, there are many things or many skills that come together. So engineering is one, and finance, mathematics, econometrics, and smart people and brilliant. Uh, it's like a faculty. If you were to take a faculty from Ivy League schools, you would find that at AQR. We have professors who have been in academia doing research and they have joined AQR. So there is a great deal of transparency and passion for research. If you want lifelong learning, then AQR is a great place to be at. How many people know what is quantitative asset management? Any show of hands? Okay, we have quite a few, so we are not totally dead in the water. Uh, so quants, as the developers are called, compose complex mathematical models to detect investment opportunities. Quant strategies are now accepted in the investment community and run by mutual funds, hedge funds, and institutional investors. They typically go by the name of alpha generators or alpha gens. This is something I found on Google because there are a lot of definitions that people refer to as quants. So we are a systematic fund and we deploy technology and algorithms in order to detect opportunities. And I'm going to be talking about, since the conversation is about Quant Demystified, so I'm going to be taking you through a series of steps that need to happen in order to be able to give you a little bit of flavor on what goes on in a quantitative asset management. So another question for you. How many people know the difference between fundamental versus systematic asset managers? Can somebody name a fundamental asset manager that is extremely famous? or not famous? What do you say? Exactly, Warren Buffett. So, yep, yep. So who is a fundamental asset manager? Traditional asset manager will be somebody called Warren Buffett. He'll be sitting in his office and going through income statements and balance sheets, be able to look at how, for example, Coca-Cola is doing. They'll be looking at earnings and how they have been doing historically. But there is a limit to that approach. Humans, we can only process so much information. Uh, and we are not cyborgs yet, so when we get to that stage, maybe we will be able to process more. But up till this now, we can only process limited amount of information, and so it's driven by manager. There is a small universe because I can only go through as a human only certain number of stocks, and it's less tech reliant. With a systematic asset management, for example, at AQR, we deploy heavy machinery, technology, strong engineering principles, and we have a wide universe that we can go through, so we can systematically have a view on what we want to buy or sell. So not even just 10 stocks, but we can go to 1,000, hundreds of thousands, or million stocks or instruments on day-to-day basis, be able to figure out what we want to have a view on. So now a sample quantitative asset management workflow. How does the workflow look like? So at the bottom, we have everything starts with data. So what is data? We have market data, we have prices of stocks, we have returns, we have financial statements, income statements, balance sheets. We have security lending information, who's lending to who, at what rate. We have analyst forecasts. As we have stocks, you will have analysts who will be making predictions on how the earning statements are going to come out, at what will be higher than analyst expectation, lower than analyst expectations, then stock tend to function, go up or down. So we have a lot of data. We take that data and then we create something called signals or factors to have a view on those stocks. Price to earnings. Earnings are higher, price is low, that means that is a cheap stock. I want to buy it. If it's the other way, then I want to sell it. Simple. Those are value factors. And we have a lot of factors that come together to be able to predict at the end of the day, whether I want to buy or whether I want to sell. And the view on it depends. And there are a lot of factors that go into it, but which I'm not going to. I'll keep it at a very high level. We take these factors and then we create something called strategies, because you can have value signals, you can have momentum signal. Momentum is something, if a stock has been going up in the past, then there will be a tendency to go up in the future. If Reliance is making money for the last 3 years, then it'll keep on making money for the next year. So that's momentum. Value is going to fundamentals, looking at price, earnings, dividends, and so have you. So after we put together different factors, we create strategies, and depending on clients, we have clients that pay us money. They have constraints, and we create accounts for them. And those accounts have specific constraints. We put together different strategies, and that's how we come up with a product. So as you see this chart, you see it looks like a pyramid, because it starts with a lot of data, then less factors, then lesser strategies, and then lesser accounts. So it's a quest really from going from data to intelligence. And there's another dimension to this. There's a time series. Because you're looking at one day, but you want to look at historically. So that's where the challenge comes in. Let's quantify this. So looking at equity markets, we have about 2 billion data points per day. Let's say we have 90,000 factors. We have 200 strategies and about 100 accounts. And then we have these number of data points every single day. Now, this is not enough. Why is this not enough? Anybody want to take a guess? Or not a guess? Sorry? These are financial data, factor views, you have your strategies, and then accounts. All the way from bottom to the top, from data to intelligence. So I have data coming in, there's a machine in the middle, there's a data coming in, and I have a view that or trades that I want to do for specific clients. Okay. Okay. It can be, that's a management signal. It's, yeah, yeah, yeah. Good point. No, that's a good one. There's a slide on it. That's a good one. Yes, historical. Because something can only make sense today if you go back and look historically. Because when you have something, let's say a price to earnings, a simple factor or signal like that, you want to go back and test it. And and that is something very important while doing research. Because research, just today, looking at data, you could be data mining. There could be so many biases that are involved. So in order to take into account those biases, you want to see whether your view holds the test of time, which I'll get into later. So those are all good points. So that goes into the emerging market, the different kinds of market. So I wanted to see, to put things in perspective, I looked at the stocks, the number of companies growth in India from 2009 to 2016, and it somewhat looks like high degree polynomial or exponential. So India is changing. There are a lot of companies out there, and not with stocks. As you have more companies, you'll have security information that's going to grow. Your trading is going to grow. There'll be number of financial statements. The financials are going to grow. There'll be many more counterparties and broker dealers to clear those trades. So they're going to grow. If the input goes up, the output goes up. So that is just one dimension to this, and there are so many other dimensions. That's why the data is huge. And be able to look at that data in a systematic manner, in a timely manner, be able to do your research, be able to do back testing, and not sit there for hours and days to even figure out whether this is something that is working or not is a big challenge. So quant analysis, some of the use cases. Can anybody point out some of the use cases that exist? I've already pointed out some of them. So do people know when you're doing any sorts of analysis, forget quant, but any sorts of analysis, what kind of things that you would want to take a look at? Yep. So exactly, that's analytics. Yep, kind of analytics. Yes, and another analytics, yes. What else? Sorry, I couldn't hear you. Okay, 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 yep, good. Risk modeling, yes, you want to make sure that your risk is appropriately adjusted. Yes. Sorry? Okay. So here are some. Uh, so you have alluded to, for example, if you have correlation, if you have regression, what we call is backtesting. Because you have a view at one point in time, then you want to go back and you want to backtest it. So you want to see how things did in crash of 2007, 2008, the tech bubble crash in 2000, or the crash in the 80s. You want to see if I have a signal or a factor or a view, how would that perform when the market tanked? If on risk adjusted basis, if your view is doing well, then you have certain degree of confidence that there's less biases involved, or this could work in the future. There's slicing and dicing of information. Once you have a data set, you want to slice and dice it. You might want to aggregate it. You want to look at different levels. You want to group things. That's where an important is worth mentioning is pandas. Pandas is a library which has been famous. It's become famous in the last couple of years. It originated at AQR. AQR, Wes, I remember me and Wes were working, we were dealing with the similar kind of problems, and we ended up creating this library which has now been open source and become pretty popular. So real-time analytics, once you have something, you want to be able to look at it real time and how things are changing. Machine learning, I mean, their talk is not complete if you don't mention machine learning. There are a lot of great deal of stuff that's been done, and once you have a data set, you have to have the capability to apply machine learning algorithms, and libraries like SciPy, scikit-learn, NumPy, and things of those nature. Moving on. So how did we achieve it? So we ended up creating an ecosystem, an enterprise platform that catered to all these use cases, and it's called Titan. So what is it? It's a Python-based framework. Python, I won't preach to the choir. People have come here for a Python conference. They know the benefits of Python. It's one of the best languages out there if you want to do any kind of data science, any kind of research. There's so many libraries that are available, so many people contributing. I think it's very rich. It's very, very rich. We chose Python because of all these qualities that it has, and then it naturally lends itself to research. We built it from the ground up, and it's cloud ready. We run it on the cloud and also on-prem. Platform agnostic. It's a one-stop shop. If I'm doing any kind of research, I want my data, I want the libraries handy so I can compute some analytics. I want to compute it somewhere because I just don't want to do it for one day. I want to do it historically and want to slice it, dice it in multi-dimensions. So I need something to be able to do it fast enough for me. And then I want to visualize it. I want to look at the trends. I want to look at, and then I want to look at charts. I want to look at data historically. I want it to be interactive. So I want it to do all these things with well-defined APIs and ease of use. So how do we do that? So we created an ecosystem to allow users to do that. And how did we achieve to be able to do all these analysis quickly? So we ended up creating our own cluster. Is called Galaxy, which is built on top of Apache Spark. It's a graph-based ecosystem. So everything is a node. Node gets attached to the graph, and the dependency management happens automatically. And it's the graph is dynamic, is self-healing, is polymorphic. And that's where maybe sometime in the future we can apply machine learning algorithms for the graph to take shape and self-heal. It's microservices based. I mean, you all know, the beauty of microservices, so I won't go into that. We ended up creating our own library called Visualize. We don't have any Python. Oh, sorry, we don't have any Excel. And we have a lot of Python. And we ended up creating our own library for Excel. because we wanted it to be all API driven and highly interactive. I'll go through a couple of examples of these libraries so that you can see in practical sense how things work and how easy they are. We use a lot of open source technologies. Some of them are listed here. In the interest of time, I'll just move on quickly from here. So this is a use case for our Galaxy cluster. So you import the libraries, then I have the function called parallel grabber. I have about 750 stocks that I want to grab returns for, and I define how I want to chunk it, which is by stock, and how I want to distribute it. So the libraries are friendly. It's just one line, and things are going to happen behind the scenes. The users don't even know there's a cluster behind the scenes. So they have a Jupyter notebook, they use a library, and then it's done for them. And then you get a result set back. Visualize. Python is the new Excel. Python has a lot of capability, and our users are smart. When you're doing research, everybody knows Python. They want it to be interactive, they want it to be fast, they want it to be quick, and they don't want to take the data set and paste it in Excel and then want to do analysis over there. So what we have done is bridge that gap. So we have created a library called Visualize, which is a web-based framework where after you have your data frames, you can take them through a rules engine or to it conditionally formatted. But in this case, I'm going to show you a very simple example of I grab a data set, a time series. It's hard for me to see here, but a time series of returns, and I have everything is config driven. I can inherit from a config or provide a config, and what I do is I just do to web after grabbing the data, and then there comes a chart. So a web page pops up. There's a chart there. It's highly interactive, and you can do so much more. You can define your own pages. You can section the pages whichever the way you want. You can embed pictures. And users is all API driven, so you don't have to do any of the visualization work yourself. Everything is done for you. So what it does for a researcher, as I'm doing my research, is very iterative, and I can share the link with some other researcher, and get feedback. I can convert that into a PDF. I can take it to a meeting where I can share it with the other researchers. So it makes the whole cycle very seamless and very robust and very quick. After what we have, Bolt is a unit of work. So I have data, I want to create analytics, I want to compute it, I want to visualize it. Once I'm happy with it, it's called a node. Here I'm grabbing data. Here I want to compute beta. Beta uses returns, and I want to do it historically for a time range on a list of stocks. So it'll go to our Galaxy cluster behind the scenes. We'll compute betas for a list of this range of stocks for this date range, and we get back a result set, and we want to visualize it. Once I'm happy with it, I can just take this 4 lines of code, create a node out of it, and then ship it to the graph that we have. So we have a beta. Beta uses returns uses prices. So there's a natural dependency there. So I can, those dependencies will be automatically created, and once you take this node and then put in the graph. I'll show you a sample how the graph looks like. So how these nodes come together. So here is our Titan ecosystem. You can see that you start at the top level and you have multiple applications, and then this is n level deep, because it depends on you how the depth of the graph. So you can go all the way from the top to the bottom and be able to look at your dependencies. These are all function objects which are stored. So you can see what were the inputs, the outputs, the context at that point in time. They run and they publish messages on the message bus, so that it's highly interactive. This is a dynamic graph. So you can imagine as your ecosystem grows, there's more analytics. You can keep on taking these nodes, and depending on dependencies, you keep on adding to this ecosystem. So it makes the whole thing very transparent. If something fails, the graph itself knows what its dependencies are. It can auto-compute. And you can apply machine learning algorithms on this graph and can do and achieve much, much more. Python is not perfect. Something at AQR is that we collaborate and we discuss ideas, and there are many ways to skin a cat, and Python lends itself to naturally to research, and we decided to use Python for this ecosystem and discuss the cons that we have, and we work to get around them. One of the things one of the drawbacks that is discussed is it's a high-level language, it's dynamic. So we have taken type hinting, it's available in Python 3. We run unit tests, regression tests religiously, and to make sure that everything is correct. The database access layer, as you know, that is not as developed as other languages. So we have created our own proprietary database access layer to take care of that disadvantage. And it's not fast enough. So if it's not fast enough, we have created a graph-based ecosystem, which is dependency driven. We use a distributed computing framework, which is based on Apache Spark, and also a caching framework, multiple levels of caching framework in Redis. That's it.
Hey, my question is more on finance side of things, on your investment philosophy, because most alternative asset shops that I've seen, which are quant only, have mostly execution-driven strategies on arbitrage and all. But as you said, you focus on security selection as well. For example, you spoke about price to earnings ratio. So even that, the earnings is still, the forward earnings is still an estimation, right? So how would you deal with that? I mean, even that, you would need some humans to do that, right? Or do you?
Well, don't need humans to do that. We have one thing I would like to mention is that we don't not only have stock selection strategies, we have all sorts of strategies. I just use stock selection as an example. That is one. The other is the analyst forecast that you're mentioning, the earnings announcements. That is also driven by data. Humans are making those predictions, but once they make those predictions or these estimates, they flow through data, that pipeline that I mentioned. And that can be systematically captured, and then you can create a signal out of it.
So essentially, you're using other folks' predictions to incorporate into your models. Right?
Yes.
Cool.
Yep. Can't do everything.
Yeah, one question from my side. So, so is there anything that you guys figured out an automated way to find out accounting frauds, like which influences the stocks, shares, and everything?
You mean accounting frauds?
Yeah.
We're not in business of actually figuring out fraud, though. Not to my knowledge. Not to my, whatever, like if there are outliers, when you're doing anything, if you were doing any regression, you try to trend fit and then see where the outliers are. As a firm, we don't bet on outliers. We don't make a view on outliers. We try to predict or look at a sample set and define that sample set and then be able to trim the outliers. We don't take a view.
Hello. Do you take any kind of sentiment analysis into your model? And apart from that, recently I have been tracking some estimations, but most of the estimations have not been reached. So can you suggest us the best estimation in the model? There's a lot of management companies are there. They are saying this may go to this level, but I'm following them, but they are not. I lost money, so can you help me out here?
I hope you make money soon. But it's hard to, I can only talk in generic terms. And I mean, obviously you take sentiment analysis as part of your data because you want to diversify your data as much as possible. So sentiment analysis is part of something that we do take into account. But hopefully that answers your question.
Hello. Hello. Hello.
Excuse me, that'll be last question. After that, we can take questions offline. Thank you.
So you mentioned that for everything that you put, if I select something, you put it on graph. You put the thing on graph, right?
If you want to.
Yeah. So if I have selected like some analyst estimates in my selection,
Yeah.
and the analyst estimates keeps on updating like every month or every 3 months or every 6 months, every quarter after every quarter. Next. So how do you update these kind of things on the graph?
There are many ways to do it. So one, you can just rerun your model, right?
Okay.
As the data changes, the model is going to change, and then you'll have a view on. The other thing is that we have something called, so we have our cluster, which is based on Apache Spark. Spark has Spark streaming. And in this graph that you saw, so if there's one of the nodes, you can say that, okay, you put a condition on it, and be like, if the data changes, compute all the dependencies upwards, right? So it'll just automatically happen. It just depends on how you want to do it. Yeah. Or instead of pull is push. You can subscribe to it. Okay, I'm interested in this and this and this. As any other stuff changes, you already have the dependencies.